Well, equities are doing well, have been doing well. So let's talk about another asset class, the rupee, which has appreciated around 0.5% to nearly 79 to the dollar as banks have sold dollars. Bond yields also have started lower in the morning despite a higher than expected inflation reading last evening from India. Lata has more. Lata, over to you.
Well, the clear performer of the morning has been the currency. The Indian rupee is 0.5% higher compared to the dollar. All the other Asian currencies are about, 0.01, 0.02. They are flat. So this is an outstanding performance, and the rupee has gone from 79.52 to nearly 79 to the dollar by noon trades. The reason appears to be a one-off. There seems to be a large, dollar inflow that came into the country some time back. It reached the bank's books. They hedged it. And today the cover ends, the hedge cover. So they had to, sell off those dollars. And that's how the dollars have hit the spot market as well as the NDF market. So this is a bit of a one-off, though you have to admit that there are the longer-term positives, which is that equity flows have started. Bond flows are expected to start when the bond inclusion happens. And the dollar index also is off its highs. So generally, it's a pro-rupee scenario or a pro-EM currencies. But this one-off buy contract, which banks are reversing today, is the one that is created this huge rally in the rupee today. We shouldn't expect this ferocity of the rupee rally to continue. But generally, there is a bit of a pro-rupee or a pro-Asian currencies syndrome because of the feeling that the dollar has peaked off. Bond markets, again, was a surprise performance. Bond prices were higher and yields lower in early morning trade when you would have actually expected the opposite because the August inflation was higher than what the street expected. CNBC-TV18 poll was expecting 6.84. It has come in at 7. It's also higher than the 6.71 of July. And food inflation was definitely higher than what the economists were prepared for. Nevertheless, the market is not even ruffled, and that's because it's only looking at one thing, the inclusion in the bond index. The meeting should be about 3 to 4 weeks from now, and the JPM Bond Index Committee, and the expectation is that they will announce the inclusion, although it may be deferred maybe by 6 months or something like that. The other important point is, in spite of the higher than expected inflation, most of the economists, especially I want to refer to two economists, the ones from SEBI, from SBI and Citi, are expecting that RBI will hike maybe at best by 35, but more likely by only 25 basis points compared to that 50 and 40 basis that they were hiking in the last two monetary policies. The reason is that already one front-loading has happened, but more importantly, the way in which the finance minister spoke a couple of days back, seeing that the centre is also picking up a lot of flack on inflation, as well as some dovish comments coming in from the MPC member Ashima Goyal.